running a business. Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor podcast, brought to you by Truelytics by Envestnet. This week on the show, I have Lucas Siegel, CEO of Harbor Life Settlements, with me for a conversation about how financial advisors can help their clients unlock new investable assets from their life insurance policies, which may open up a whole new landscape of opportunities for their financial lives. This is yet another episode keying in on the theme of showcasing new ways that financial advisors can expand the services they offer clients and open up new avenues for growth for their advisory businesses. But before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a guest or a topic for the show, hit us up. Simply go to Truelytics.com and use that little contact form there, or shoot us an email, podcast@Truelytics.com. Okay, let's get to the conversation with Lucas Siegel. Well, Lucas Siegel, so wonderful to see you. Welcome to the Modern Financial Advisor podcast.
Mike, thank you so much for having me. Really appreciate it, man.
Dude, I'm totally thrilled to have you on the podcast. It's really interesting. This is like you're like the fifth or sixth guest over the last year who's actually been here in Austin. And I really do feel bad because I should just say, hey, why don't we get together? We'll record in the same room. It probably would be a little more fun. So you know what? Rain check to you, future podcasts, you and me in the same room recording. It makes it a lot more interesting. But hey, the internet also works and makes everything nice and convenient. So we're here. We're ready to rock and roll.
Awesome. Cool.
Yeah.
Keeping Austin weird. I love it.
Exactly. And I do feel weird. I've got new specs on. So for the people who are like frequent viewers or listeners of this podcast, I'm wearing new glasses and I am a glasses guy, but I'm just getting used to it. So I'm feeling weird at the moment because they also have that thing where they tint a little bit if it gets too bright outside. And I can't tell if they're tinting now, but we'll figure that out. Who knows? Anyway.
The
all right, buddy.
Mysterious look. I love it.
Exactly. Well, listen, I'm super thrilled to have you on the show because I'm looking to learn a lot in this episode, and it's not often. I've been in this industry now for like 27 years, right? And I love the financial services industry at large because I'm constantly learning new things. Just when you think, all right, we've got this all figured out, somebody else pops on with a new idea that you don't know that much about. So I'm looking forward to diving in. One of the things that you kicked off in our prep call was something that just made me do one of these, what? Really? And I have a feeling we're going to have a few of those record scratch moments for members of the audience as well with this thing. You said in the prep call that $200 billion of life insurance policies lapse every year. Is that true?
Yeah. So you can get that every year. There's something called the Conning Report. Every 2 years it's published. It's an industry publication. It talks about life insurance and life settlements and liquidity in senior markets and what's happening to all of these life insurance policies that are sold. And it's really flabbergasting that, for universal life policies, I believe it's 87% of all universal life policies end up lapsing or surrendering. So on average, I think across the different types of insurance, it's about 90% of all life insurance policies are lapsed or surrendered and not paid a death benefit.
That is just
so
bonkers.
It's shocking. I can't think of any other industry maybe in the world where if you create a product and you don't deliver 90% of the produce, people keep buying it. But life insurance is that. And I'm not trying to diminish the idea that life insurance is valuable, because I think it's extremely valuable,
right,
to so many different families. But it's life insurance is something that dynamically changes with families' financial choices, liquidity needs, macroeconomics, what happens to their family, what happens to their heirs. And it's a dynamic asset that needs to be adjusted. And so many people don't understand the value of it, which is a problem.
Yeah. Well, and by the way, that probably explains why insurance agents are able to basically make the entire revenue of a first year of a policy as their commission when they sell one, because it's like, hey, listen, we know that this thing's going to be incredibly profitable. Most people are going to be paying into this insurance policy for a long time and probably let it lapse, and we're just going to be able to keep all of the revenue, right?
If you go to New York City, like you look at some of the tallest skyscrapers in America, a lot of them are owned by insurance companies.
Yeah. Yeah.
Um, and so if you create a product that you don't have to deliver the end and deliver to the end user 90% of the time, you're probably
Yeah.
gonna have a lot of cash.
That's right. Well, and listen, we didn't have you on the show, and as you mentioned, we don't want to sit there and just like rip on the
Yeah.
insurance industry. The reason why this is so important is we're gonna be talking about a huge hidden AUM opportunity for financial advisors and an opportunity for them to serve their clients better. And we've kind of been on a roll lately on the show talking about that, about how financial advisors can expand not only their business, but expand the value that they provide to their clients. And we're in I kind of feel like this is a peak opportunity time for financial advisors, right? For the longest time, most of them, you hear me say this on the show all the time, got their start as stockbrokers, right? That's what they were doing. They were selling, stocks, bonds, mutual funds. If you were an RIA, you were advising on somebody's portfolio and managing it for them. But now we're entering a new era where it's becoming easier and easier for you to serve your client a little more broadly because of companies like yours, Harbor Life. So I want to dive into something that really relates to that hidden AUM opportunity. When Claudia from your communications team reached out and to recommend you as a guest, I do a little bit of research here, right? I understand the insurance industry because, to be honest with you, I know insurance. I mean, I studied it in college and grad school. I understand the difference between term and, and whole life and all that type of stuff. But as I suspect, most of our audience is kind of with me. They're not as knowledgeable as they would like to be. So as I like to do, and they have a saying in the military, let's break it down Barney style, make it really simple so everybody can understand this. What is a life settlement? And why is this concept such a powerful hidden AUM opportunity right now for financial advisors?
Yeah, great question. So life settlement is a very misconstrued word.
Mm.
And a lot of people have different opinions about what it means, but I'll give you the breakdown.
Yeah.
Life settlement is basically the selling of a life insurance policy
Mhm.
so that you don't have to wait until someone has passed to get some of the benefits of the policy.
Okay.
So, they call it life insurance, but if you can't use that money while you're alive, it's not
Yeah.
really life insurance. It's
Right.
death insurance. And so a life settlement is, let's say for an example, let's say an 80-year-old male has a $1 million life insurance policy. They're tired of paying the premiums. Their kids don't need the money. They have a liquidity issue that they need to pay for long-term care. They want to go on a cruise. They want to buy a boat, whatever.
Yeah.
Um, that individual can sell their life insurance policy to a third party institutional investor or third party investor. So that $1 million policy, they might be able to get $500,000 cash today, never have to pay a premium again. And then when they pass, the person who bought the policy gets the $1 million.
Makes
So
sense.
it's really a liquidity opportunity. There's a term in life insurance called the cash value,
Yeah.
which is what most people and most advisors, when they look at a life insurance policy, they think the value of the policy right now is the cash value
Yeah.
or the death benefit. But that's just not right.
Mm.
A lot of the time. Because a lot of times, so the average life settlement sells for 4 to 12 times the cash value.
Mhm.
So the cash value is not really what the value of the policy is in cash.
Yeah.
And this all happened, life settlements all happened as of a 1911 Supreme Court ruling, Grigsby versus Russell, which was a case where the Supreme Court basically ruled that life insurance, just like your house, just like your car, just like the shirt off your back, life insurance is private property.
Okay.
And because it's your private property, you have the right to sell it, just like you can sell any other asset.
Really interesting. And so is this only applicable to whole life insurance or something that actually has a designated cash value? But let's just say somebody was 75 years old and they had a term life insurance policy for 20 years. And it's like, so, okay, actuarial tables say that this policy is going to be paid. This person's not likely to live beyond that term. Can they sell the term policy as well?
Yeah. So
Oh,
you can
okay.
sell term policies. You can sell, we sell a lot of convertible term policies.
Okay.
So certain term policies or terms that your terms are super cheap,
Yeah.
but they only work for a certain amount of time. And then at the end of that time, some terms have something which is a conversion rider,
Okay.
which allows you to take that same policy. Let's say you got initial health underwriting 20 years ago for a 20-year term, and you can convert. Let's say you're issued standard plus or standard preferred, which means you're pretty healthy.
Okay.
You can convert that term policy that you've always had into a permanent policy, like a universal life policy, without having to get your health rechecked.
Interesting.
And so that's what a conversion is. So at the end of the 20 years, I want something super cheap for now. And then 20 years, my kids are grown. I might want to keep it, keep it for estate planning tax
Yeah.
purposes or whatever. You can convert it into a longer term policy. And most people don't do that. They don't convert the policy because it's more expensive.
Mm,
Converting it from a term to a universal life is expensive.
yeah.
But what we do, we've actually got a term conversion growth engine within our firm where we've got basically like policy scientists that look at a policy and say, can we sell the policy, convert the policy, and then sell it? So if someone was going to lapse their term and get nothing,
Mm-hmm.
and because they didn't want to pay the money to convert it, we can run the math and say, if you convert it, we might be able to get you, let's say I'll give you an example of a real case I was looking at
Yeah.
yesterday.
Great.
This was a 65-year-old, which is super young for life settlements, just FYI. But it was a 65-year-old with a term that was a $10 million term. We sold the term as a conversion, converted the policy. So the guy was going to get nothing because he was just going to let the term go away. We got him 275 grand cash. So found money. And then the policy was converted into a universal life policy. And then we ended up splitting the term conversion fee and getting the client as much money as we could.
You know, there's so much value in what you just described there, right? So I think any advisor who's listening is kind of doing the old chin scratch, going, "Oh, I could see opportunities for my clients," right? Because many of your clients are coming in and they have an asset shortfall, right? In a portfolio, like, hey, um, in order for me to achieve the goals that I'm laying out here, whether it's travel in my older years, the estate I want to leave my kids, or just I don't know, just enjoying life. I'm a few hundred grand short, right? Where can I find that cash? Well, you get this life insurance policy that will matter less to you later down the road, right? You've already raised your kids and all that type of stuff. You can convert this. There's just so many reasons why somebody may consider doing something like that. So it's really, really uh, pretty fascinating to think about all the applications of such a tool.
One of the things that we always like to talk about is a lot of advisors that we work with. So we work with the top 1% of life insurance producers in the country.
Mhm.
So don't think that I'm not talking well about life insurance producers.
Yeah.
We have some incredible professionals that we work with
Mm.
that do an outstanding job for their clients and promote life settlements in a way that it should be promoted. But as far as the, RIAs and registered reps that we work with, a lot of our guys use it as if they're measuring net worth
Mm.
of a client to decide, what type of assets that client should be doing, what type of diversification should be in that pool for that client. Most RIAs and registered reps are ignoring the true asset value of someone's life insurance policy if sold on the secondary market.
I'm glad you brought that up, and I wanted to circle back to that. So perfect segue on your behalf. Thank you of teeing me up. Baller move. The so the cash value. Going back to the cash value, that is what the insurance company, whoever holds the policy or is underwritten the policy, has decided this is the cash value. So they've run their own net present value numbers on the policy value and saying, hey, if we had to cash you out right now, give you money, this is what we'd be willing to cash you out at right now. However, to your point, somebody else is coming in and saying, I will buy this policy and I'm willing to pay you more, right? Because I can run my numbers, my cost of capital, and my business model is dramatically different than the insurance company's business model here. I can go ahead and offer you a higher price for this asset, right? This is the way it's working.
It's kind of
Okay.
yes and no.
Okay.
So the cash value, life insurance companies are not as, from a policy by policy basis, not as financially articulate as what you just described.
Okay.
So the cash value is that's not how they look at cash value. How they look at cash value is you've got something on an illustration, and anyone with clients with life insurance policies is probably going to hear this complaining about paying premiums
Mm-hmm.
because it's like the never ending saga, right?
Yeah.
having to continue to pay premiums, which takes out of the AUM
Yeah.
and is a nightmare for everyone. They tell you that there's an illustrated amount of premiums that they're advising that you pay on the policy, which is a little bit above what the policy actually costs.
Mm-hmm.
And they do that so that you build up additional cash in the policy above what just the pure raw expenses to keep the policy alive are. And so that cash value goes up and up and up as you keep paying the premiums that they're telling you to pay. You don't have to pay those premiums. You can pay less. And we actually have a service that we also work with reps on, where we look at what they're told they have to pay, and then we tell them what they actually have to pay.
Yeah.
If they don't want to build up that cash value. So if someone stops paying premiums, so like universal life policies are an example where they're flexible. So if you've got $150,000 in cash value in there, you don't have to keep paying premiums necessarily. You can stop paying premiums for a couple months and they'll just charge your cash value to keep the policy going.
Yeah.
But the issue is that most people they don't have a team like ours in the background that supports them in doing valuations. We do valuations all day, every day, even if a family isn't necessarily trying to sell their life insurance policy, so that they understand their options and the liquidity value. So it's not like oh yeah, my client definitely wants to sell their policy. So a lot of firms use us as kind of a back office service so that when they're meeting with their clients, they can just ahead of time already have some valuations about what that policy might be worth, so that people aren't stuck thinking that their policy is only worth the cash surrender value or only worth the death benefit. And it allows financial advisors to explore a holistic wealth approach, because some people might have really good options to invest, but there's certain hurdles on how much they have to put in to even get into the certain funds or into certain real estate deals or whatever. And they don't think they have that liquidity. So when advisors come to us proactively and during annual reviews, annual meetings with clients over the age of 75, we just have those valuations ready for them.
Yeah.
And it opens up a ton of doors for families that they didn't even realize that they had.
100%. And I'm gonna go back to the whole, we don't want to be crapping on the insurance industry because the value is so important for people. But there's important to remind advisors and anyone else listening or watching that there is an important distinction, right? So an insurance policy is a guaranteed contract, right? So this money is effectively risk-free to the client who holds that policy, right? So that in the event that something happens, there's no option for the insurance company to not pay. It will have value, right? So there's no market risk to this thing. And most insurance policies are reinsured by another insurance company so that, if that insurance company fails, it's okay. Your policy still gets paid. That's kind of like FDIC insurance for your bank account. But like your bank account, the rate of growth, the rate of return is relatively small, right? Because there's so little risk involved, because they must pay it. They can't just take this money out and go, you know what we're going to do? We're going to put this in crypto over here. We're going to do all these other derivatives and crazy stuff with these assets just to see maybe we can beat the S&P 500. No, they don't do that, right? So there is value, and most wealth managers will tell you of like stock market offers the best return possible for you. Like a well-balanced modern portfolio can achieve your financial goals over time. So that's one consideration that they might be thinking of as they're exploring this.
So one thing that we do to that point, I'm going to hit on 2 points that you just made. So you
Yeah.
talked about risk-free. I would say life insurance is default risk-free. So if you keep paying your premiums and you pass away, I don't think there's ever been a life insurance policy that has not been paid when
Yeah.
it's been paid up appropriately in US history. But there is a huge risk for families, which we call longevity risk, which is what if grandma, grandpa, mom, dad lives 25%, 5% longer than you expected, and you are having to cover long-term care costs and insurance premiums that go up as they age.
Yeah. Yeah. It's interesting. You just hit on exactly what I want to talk about. But my next thing, you're just crushing it today. The inflection point, right? So insurance is a tool, as we've kind of covered here, like to guard against catastrophic risk, right? So what happens if the catastrophic loss happens to me? So we pay a little bit of money each month to insure us against the risk of a big, expensive event that may happen that would be catastrophic to our financial lives or our family's financial lives. So as my old business school professor mentioned, just very similar to you, he said, hey, look, there's two great risks in life, dying too early or living too long. And you was talking about living too long, right? Like, what if I live to 100? I'm going to 100, by the way. We were talking about that on a prep call. That's my goal. I'm going to make it.
I believe that. You look
But what
healthy.
happens? What happens if you live to 100, but you only had a portfolio that was designed to have you live to 90, right? Like, oh, that sucks, running out of money and being 90, having to go back to work, right, would really stink. Or having to live, in your kid's basement or something like that. I don't know. But
Well, and
no,
then on that note, and then you lapse your policy because you can't afford the premiums because you can't work because you're 90, so you're out of all of it.
right, that blows, right? Exactly. So, we have insurance for the dying too young part, but there's less insurance opportunities for the living too long risk. I mean, yes, there's long-term care insurance and so forth, but that's very specific use case of in the event that you're old and you have to be in a nursing home or something like that. That's when long-term care insurance kicks in, but it doesn't just kick in because you're old. You run out of money. Best of my knowledge, I don't think there's a policy that exists for there. So there's this inflection point, right? I'll use myself as an example, right? I have two teenage kids. One's in high school, one's about to go to college. Right? He's in high school still, but he's graduating in a couple of weeks, right? He's going to go to school. So I'm still in that I need life insurance part of my life, right? Because man, if something happens to me, I want to make sure that colleges, everything goes smoothly there, and my wife doesn't, have to sell the house and all that type of stuff. I just want to be safe and secure for the family in the event they're not here. But I imagine there is an inflection point, right? Like when have you guys studied that? Like when does this make most sense for somebody? At what age or what financial crux or whatever should they start considering this?
So that's our job,
Yeah,
honestly. um, is to work with advisors to mathematically point out that inflection point with precision. So when someone does evaluation with us, and a lot of times their clients don't even know that they're doing this.
yeah,
We do it in the background because it doesn't, we're under NDA and we're their back office. We actually have a spreadsheet that's part of our pricing deliverables that maps out, okay, this is what the policy is worth if they're healthy on a secondary market.
yeah,
This is what the policy is worth if they have some health impairments. And we go down the line, and with our spreadsheets, the advisor can change the different life expectancies, and it shows dynamically what the policy might price at a certain market rate. But then on top of that, we have something that we chart out, which is called the opportunity cost matrix. So if so people think of selling their life insurance as just getting a lump sum, but that's not really the equation if you're
Okay.
looking at the future value of money. So if you sell your life insurance, if the advisor can get you into some sort of fund that they feel is really secure and good for your risk profile that can get a 9% return, when you sell that money or when you sell that policy, you can invest it into that fund at a 9% return over your life expectancy. And we chart out how that value adds up over time. And then on top of that, we chart out if you would have kept the policy, how much money you would have had to pay in premiums every single month. And instead of paying those in premiums, if you would have invested that at 9%, you get to the future value of selling
Right.
the policy with correlating in the life expectancy and the opportunity cost. And those are dynamic, and we help advisors mess with that so that they can literally see what the inflection point is for every single case that we underwrite. And we do this for free.
That's really smart. I mean, so breaking it down, finance lingo, right? So we basically have it's not just the present value of a future lump sum in the case of what if this life insurance were to pay out, right, at some point in time. It's the present value of a future lump sum plus future value of an annuity, right? So we're talking about future value of annuity because you would have been paying premiums. In order to maintain that, you had to pay these premiums. And let's just, if it was $200, $300, $1,000 a month, depending upon whatever your life insurance looks like, you would still have been paying that. So what if you were paying that into it? And by the way, starting with this lump sum, what does that future value look like, right? So it's a little bit, I like that we're breaking this down this way because as I've also said on the show a few different times, you'd be surprised at how many financial advisors did not study finance in college or weren't finance majors, right? And so this is not to throw shade. It just means like some of this stuff might be new and outside of just their expertise so far in their careers, and this could be relatively new. So I really think it's important to explain this type of stuff.
Well, not only that, like the only firm that I've ever seen that lays it out like this in the industry. So it's a fairly new concept because historically people have just been like, how much money can I get right now?
Right,
They haven't thought about what could I do with that and what's the risk if I don't do that.
right,
And so
yeah.
we literally have a chart that's like, should I keep it? Should I sell it? Should I surrender it? And we answer the question based off of the life expectancy
Smart.
and the family's risk profile.
Love it. So you went into some great detail there because my next question was like, how does this work mechanically? And I think you've sort of hit on all of those pieces in relevant detail. And I'm obviously more detail if somebody were to talk to you one on one. But let's talk about the advisor and how it works mechanically for them, or how they should work this into their business. Because I think for I'm probably maybe I'm wrong, and I'd love to hear if I'm wrong if someone wants to hit me up in the comments or whatever on this. But like, I tend to believe most financial advisors have never gone through this process before. They are aware that their clients have an insurance policy, so they have factored that in if they actually do financial planning for their clients. They have factored in the notion that hey, when you pass away, there will be X amount of dollars from a life insurance policy that will go to your heirs to pay for whatever it is that you want to pay for estate taxes, pay for just fund your kids or your grandkids, whatever. So they factor that in, but I doubt many of them, as a core component of their practice, uh, have any expertise in asking questions about this, about approaching this concept. How do you work with advisors, or how do you recommend advisors? Maybe that's part of the same question. Like, get started incorporating this into their business.
So one of the questions we like to ask is, why did you get the life insurance policy? Do you have life insurance, and why did you get it? A
Okay.
lot of families and a lot of high net worth people got the life insurance, let's say in 2000 and 2001, when the estate tax exemption was $675,000.
Mm-hmm.
Right now it's 12.9 million. So, a lot of people got a life insurance policy for an estate tax problem that no longer exists.
Right, right.
So, just asking that question, if they have life insurance policy, why?
Yeah.
To understand what was their reasons. Um, and then the next question is, are they curious about learning what the value of that policy might be if they didn't want the policy anymore?
Yeah. That's wild. That's such a it's such a basic concept, right? Like, why did you do this? It's kind of like when an advisor sits down with their clients and they start asking them about the things they want to achieve in life, right? Why are you saving so much for retirement? And it sounds like a silly question. But it's like, well, it matters because some people may want to live a more fulfilled life while they're young. They might want to do some adventure travel and some other crazy stuff that costs a lot of money to do now. And they might be okay with, hey, when I'm 75 years old, I don't care if I'm spending, I'm a little more sedentary, if you will, right? Because I'll broken all my stuff. It'll be beaten up and won't want to move around anyway. So it's a really important question. I love that.
Well, another thing that so we don't just focus on selling the policies, we also focus on restructuring debt on
Interesting.
policies.
Okay.
So, so a lot of like whole life policies have loans on them
Okay.
because some of these policies were sold in a way where it's like you can be your own bank,
Mm,
and you can build up the cash value and then loan against it. But if you look at the loan terms, they're like 7.5% to borrow against your own fully collateralized cash. And you're not your own bank because you're paying the insurance company that interest. You're not paying yourself. So you're
mm.
paying someone else interest to get loans off your own cash. You would have to be the dumbest bank in the world to do that.
Yeah.
So
Yeah.
what we do, and same with premium finance cases. A lot of super high net worth people have used premium finance to fund big, big, big policies. And now that interest rates have gone up, some of those policies are going underwater. So we work with some big, big, big refinancing companies that are specialized in the space. We're one of 5 companies in the world that are allowed to sub-distribute this, where if someone has debt on their life insurance policy, many times we can get them completely out of the debt, keep them with a retained death benefit, and make them not have to pay a premium again.
That's fantastic. That's fantastic. I'm glad you explained that because as we're really exposing here, this is a complex situation, right? So many people's financial lives become way more complex than you think about, right? You think about, okay, I've got my debts, I've got my mortgage and car payment or whatever that is. And maybe they own a business or they have a job or whatever that stuff is. And they've got a 401k and some of their, other retirement assets and maybe some other investment assets. But when you start to branch it out, it can be complex at some point in time. To your point, somebody may have taken out a loan against their life insurance policy for whatever reason. Somebody may have bought it because they're thinking, hey, this is a good tax planning instrument, right? I've got a business and someday I may sell that business or whatever, or when I die, I want to pass it on to my kids. The life insurance will help pay off the tax burden on that estate or whatever. Um, that tax piece, by the way, uh, are life settlements tax free like the proceeds of an insurance policy?
No.
Okay, good.
It depends. Actually, the answer is it depends.
Okay,
So, which every great answer is it depends. I know
yeah,
that.
yeah.
So the way taxes work is you've got the amount that you've paid into the policy, which is called your cost basis. So let's say
Yeah.
over 30 years you've paid 700 grand to keep this policy active. If you sold your policy for 700 grand, it would be tax free.
Okay.
If you sold your policy for 800 grand, 700 grand of it would be tax free and 100 grand of it would be long-term capital gains.
Makes sense. Okay. So it's very similar to like the cost basis of an asset, right? So if
Yep.
that asset was depreciable or whatever, and then you're able to get to a point where like, hey, okay, this part is tax free. what the rest is, right? So there is a gap there. I'm glad I asked that question because I did not know that, but it just really, I know part of the reason why a lot of people love their life insurance is like, hey, this is going to be tax-free income, tax-free value at some point in time.
And families see, I mean, we show the benefits of the tax advantage upon a death. And then we show the benefits of actually getting good rates of return with that money,
Right.
and not having to pay premiums. And we compare them to see whether it's worth it to get an asset that is tax-free.
Smart, super smart.
And sometimes it is worth it. Like a lot of times we do these underwrites and we tell the family, like, keep the policy.
Yeah. Well, and if you're dealing with a fiduciary, as an RIA, as an example, that's their duty, right? They will say, hey, no, my advice is this is best for you, right? So this is not a scenario where we're trying to like take an old lady's life insurance policy here and like make as much money on her as possible, right? This is a scenario where you're trying to do the best for the client, like what is best for their holistic financial life, the goals they're trying to achieve. And it should include an evaluation of any life insurance policies they have.
We're a fiduciary as well. So it's full alignment.
Love it. I love it. Okay. Getting ready to kick for home here, but I would be remiss if I didn't dive into this next topic. Anyone who actually knows me knows I have a little bit of a comical fear of robots and artificial intelligence. I mean, I watch a lot of sci-fi, which probably is a reason why I'm extra afraid, because I Battlestar Galactica stuff. I really feel like the Cylons are coming eventually. We're all gonna die. I'm just telling you. Or maybe hopefully we work for a good robot, a nice robot. Anyways,
That'd be nice.
Yeah, exactly. On your website, the reason why I'm bringing this up, you say that in 2022, Harbor Life launched My Policy Predictor, which I think you've hit on a little bit here. It's the world's first AI-powered life settlement calculator that enables advisors and insureds to underwrite a policy in minutes, not months. So let's get into it. How is AI helping this process?
Yeah, so technology is playing a big part in what we do. While we are a life settlement brokerage, we're really a technology company that's here to help and serve the industry.
Yeah.
One of the issues is that, you go on Zillow and you type in your address and there's something called the Zestimate, right? Where people can approximate what they think the value of their house is. It's always wrong, but at least it's an estimate.
Yeah.
So there's less ambiguity, and that allows people to know that their house actually is worth something.
Yeah.
That didn't really exist for life settlements. So what we did is we got a team of PhDs, data scientists, insurance specialists, and actuaries, and we built an AI tool, which is the industry's first machine learning and artificial intelligence driven tool that can predict what someone's policy might be worth within a minute. And it used to take 3 to 6 months. So advisors can create their own account and just check, just go on the Harbor Life Brokerage website and they can just, if they're curious about what one of their clients' policies might be worth, they can just click in quotes all day. And we can upload, if an advisor knows he's got, 60 clients above the age of 65 that have a policy, we can upload them all into the AI at once and underwrite all of them instantly.
Yeah.
Which is pretty shocking.
It's so amazing that these tools are becoming, and again, I tease about the artificial intelligence and the robot stuff, but these tools are dramatically improving the capability and the response time for advisors to serve their clients, right?
So the answer to your question is yes. Great financial decisions can only be made with great financial information.
Yeah.
And a lot of this insurance industry and this life settlement industry, a lot of people have made a lot of money by obfuscating data that belonged to the people that needed to see it.
Yeah.
And our job is to rip down those walls, those barriers to entry, so that people can make the best financial choices humanly possible. And their advisors have an auditable, fiduciary driven approach and partner so that it helps families. On top of that, talking about opaqueness and people making money off of opaqueness. Um, there used to be like this industry was driven by like a handful of people that knew each other that would cut inside deals with each other and wheel and deal. And there was zero granularity or specificity about how many bids you got, all this
Yeah.
stuff.
Yeah.
A lot of people have made a lot of money in this industry by dissolving the idea of transparency.
Yeah.
So we built an online HIPAA compliant cyber secure auction site and put almost every single institutional buyer in the world in one place in a blind bidding auction, so that when we do sell a policy, we pin them all up against each other and drives up the price. And you can see the bidding performance in the bid history by the minute.
Love it. That's
It's pretty fun.
It's great. What you're describing there is this shift from product sales, right, to advice, genuine fiduciary advice for a client, right? You know,
Yep.
the history of this business is on product sales, right? Again, most of the people in our audience got their start when they were called stockbrokers, right? They were selling stocks, bonds, and mutual funds, or they were selling insurance policies, and they were earning some sort of commission. But over the last couple of decades, the shift has gone to advice, and so you see more and more advisors are going into the RIA space. They're less concerned with the actual product unless the product suits their client's needs and fills a need. Well, those walls are getting help being torn down by that relationship, right? I need you to understand an informed and educated client is a way better client here. I don't need to hide the fees anywhere. I don't need to try to make a product that's so confusing that you just go, sure, that's why I hire you, Mike, is you're way smarter about this product than I am. It's like, no. Let's talk about the process. Let's talk about you and your financial life. I
It's a
love it.
cool shift of the economy. A lot of my mentors call it conscious capitalism,
Yeah.
where it's about doing the best damn job humanly possible to serve as many people as humanly possible in the most transparent way, and you will win.
I love it. Fantastic. Okay. So we're almost out of time here, but I have one final question for you because I've asked these types of questions usually at the end for most of our guests. I like to think about the future a lot. We call this the Modern Financial Advisor Podcast. We're helping advisors modernize their business, and I think this conversation already has served that purpose. But when you think about the future, right? So you've already kind of modernized this process of life settlement. Uh, what are you thinking about 10 years from now? Where do you think we're going to be if you had to future cast 10 years from now, based on the trends of what you're already seeing? How do you think the life settlement process is going to evolve even further?
I think that right now there's some wirehouses that don't even allow life settlements
Mm.
because they're afraid of being sued, because they're in cahoots with the insurance companies, etc. I think 10 years from now, what we do is going to be required because and RIAs and financial advisors are going to be required to um, present this information. When you look at Reg BI and all those changes that happen, that's great for securities, but it didn't touch on life insurance policies that weren't securities. And people need to know the value of their assets, especially as we have this silver wave and Medicare, Medicaid, and Social Security in such tough shapes. We need private pay funding opportunities to make sure that the baby boomer generation is taken care of in these rising inflationary periods of medical expenses. And this is an incredible asset tool that's going to exponentially grow. And I think eventually the insurance companies, even though they don't like me doing life settlements right now, I believe they will be the biggest buyer of these.
Love it. I like the fact that instead of it being like hey, here's this new technology that's coming, you were like, hey, this is going to be probably a combination of, uh, what we consider fiduciary responsibility process and also probably a regulatory one, right? Like the regulator is going to come in and like, you need to talk about this type of stuff. So I love the fact that that's the angle you went versus you're like, oh yeah, this new technology is going to come out and just change the world or whatever, or these new whiz bang product or something like that. Fantastic stuff. Well, Lucas Siegel, people are going to want to follow up for sure. They can go to harborlifebrokerage.com and learn a little bit more there. Where else are you hanging out? You're on LinkedIn, you're on other social channels, you have your own podcast. Tell us about how other people can follow along with you as well.
Yeah, I'm on LinkedIn. Add me on LinkedIn and go check out our website. We've got an exceptional team of specialists, and we love designing with financial planners how a case looks and liquidity options, and just serving as many families as humanly possible. And it's a great income opportunity for advisors as well. It's like you can help your clients out and you can make fees on top of it. It's a no-brainer, plus adding AUM. So check us out on our website. Add me on LinkedIn. It's Lucas Siegel. And I would love to connect with you guys and get feedback. If you love me, if you hate me, if you want to learn more, I'd love to get to know everyone. So thanks.
Wonderful, wonderful. And we'll make sure we get all that stuff linked up in the show notes for this episode. Thank you very much, Lucas. Have a great day. Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always great to have you with us. Huge thanks to Lucas Siegel from Harbor Life Settlements for coming on the show. I love his passion about creating new options for your client's financial future. I mean, that $200 billion of annual lapse policies number, man, that's just monstrous. So make sure you check with your clients and their families. Don't let that value evaporation happen to them. All right. As I mentioned at the top of the show, please make sure you subscribe to the podcast on your preferred podcast platform. And if you haven't done so already, give the episode a share on LinkedIn. Chances are, if you found it interesting, so will your network. Okay, that's it for today. As always, be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya. Bye.